All right, I want to start the show off talking about what was extremely interesting a week in the market. The Federal Reserve met this week, as they do every 6 weeks or so. People expected them not to raise interest rates, which they did not. People expected them not to say that they were going to stop their quantitative easing or the printing of $120 billion a month to buy U.S. Treasury bonds, mortgage bonds, and corporate bonds. And they didn't say any of that. But they did say one thing. Previously in the March meeting, the last meeting before this, they stated that they weren't probably going to raise interest rates till 2024. Now, how they could project out 3 years and decide they wouldn't need to do that, I find that hard to believe how they do that. But in this meeting, they intimated that they may make 2 interest rate hikes in 2023, which would amount to 2 1/4% increases. So from 0% where we are now to 0.5% by the end of 2023. 2.5 years out. Now, you think the markets would not overreact to such a statement, but they did. Now, the markets took that statement as hawkish. What's hawkish mean? Well, there's 2 different ways of looking at the Federal Reserve. Was their announcement hawkish or was it dovish? Hawkish means that tighter money supply, higher interest rates, less accommodative to the economy and the markets. Dovish is when, they're very accommodating to the markets. They're continuing quantitative easing. They're not going to raise interest rates anytime soon. But the market took this statement as hawkish, something that they're going to do 2.5 years down the line. Now, on Thursday, the day after the statement, one of the Federal Reserve Board members, Bullard, came out and basically said, well, maybe by the end of 2022 we may have to, which again roiled the markets even more. You got to understand, these markets, whether it's the stock market, whether it's the bond market, whether it's the housing market, whether it's the commodities market, all have done incredibly well, have blown into bubbles because of the Fed's dovish monetary policy. The printing of money, the zero interest rate policy, has all found its way into assets. You don't create trillions and trillions of dollars and not have prices go up because the money's got to go somewhere. The reason is the 34,000, 33,000 stock market right now is not because of the economy, because it was there in the middle of the COVID last year, with 70 million Americans laid off from work, people stuck at home, businesses closing left and right, supply chain shortages, and the market hit record highs last year. It wasn't because of fundamentals. It was because of the Fed monetary policy. And there's an old saying on Wall Street, don't fight the Fed. Meaning that if the Federal Reserve is accommodative, you want to be in the market. If the Federal Reserve is raising interest rates or pulling liquidity out of the system, you want to be out of the market. And think about it as a drug addict. All markets are drug addicts right now. And the drug of choice is monetary stimulus. And the Fed has certainly provided that in the tune of trillions and trillions of dollars over the last couple of years. Actually going back to 2008, the great financial crisis. And that's the danger of easy monetary policy, is you blow bubbles. And every bubble gets to a point where it pops. And when it pops, asset prices drop precipitously, people get wiped out, and much money is lost, and it becomes a deflationary economy, and you go into recession and all that kind of stuff. So just the fact that the Fed said that maybe at the end of 2023, 2.5 years from now, they may raise interest rates 0.5%, sent markets into a tizzy. And I think a very dramatic overreaction in many markets. So after the statement came out that roiled markets, the chairman of the Federal Reserve, Jerome Powell, did a press conference. And he kind of walked back the hawkishness of the Fed. And this was his quote, okay? he's talking about quantitative easing now. Now, there's two different things that the Fed does to stimulate the economy in a dovish environment. A, they keep interest rates low, and in this case, zero, which makes the borrowing costs for everybody from mortgages to car loans to what have you, to corporate bonds, corporate borrowing, government borrowing. It keeps it low, which low interest rates are always good for an economy. Think about what's happened to housing prices. Well, that's a result of low mortgage rates. The stock market, as I mentioned before, commodity prices. So low interest rates is one way to stimulate the economy. The other is through quantitative easing, and the Fed has been doing both. What's quantitative easing? Quantitative easing is when the Federal Reserve buys assets. And usually it's bonds. So since the crisis hit in March of last year, the Federal Reserve has been buying $120 billion of Treasury bonds, mostly Treasuries, $80 billion of it, and the other $40 billion is corporate bonds and mortgage-backed securities. And that's another way that the Fed has been able to influence the housing market and the mortgage market, is by buying these bonds. When you get a mortgage, they're packaged together with 1,000 other mortgages and turned into a security, and pension funds and insurance companies buy them up. And individuals could if they want to. And that's what the Fed has been doing. So by the Fed providing that liquidity into the mortgage market, by buying the bonds, it's been able to keep mortgage rates down. So any hint that the Federal Reserve is going to stop quantitative easing is going to have an adverse effect on mortgage rates. Now, the Fed didn't say when they were going to do it. They didn't say anything about stopping quantitative easing anytime soon. But Jerome Powell said that the committee had discussed the matter. Now, this is a very typical Federal Reserve quote that you would hear here. You have to parse the words. Quote, you could think of this meeting that we had as the talking about meeting. So we talked about possibly stopping quantitative easing sometime in the future, but did not say a date, time, or what it would take for them to stop. But Powell reiterated that the central bank would give plenty of warning before it actually starts tapering its bond buying program. So the mainstream media, the financial media, all they were obsessed about was the possibility of rate hikes. And we're talking two minuscule 0.25% increases in 2.5 years from now. And it rattled the markets. Now, one thing that came out from the meeting is that obviously inflation is much hotter than they were telling us. Specifically import prices, export prices. And this doesn't indicate that inflation is transitory, because that's what the Fed's been saying. Well, this inflation that's happening now, it's transitory, it's not going to last. Yeah, it's transitory, right? We're going from bad inflation to terrible inflation. But the Fed is just doesn't care. Because if it cared about it, it'd be raising interest rates now. Not talking about raising them 2.5 years from now. And the main reason that prices are going up, forget supply chain interruptions and all that other stuff, it is the printing of money. It always is the number one cause of inflation. So after the Fed statement came out, gold sold off, silver sold off, the dollar gained value against other currencies, and stock markets tanked. So the markets perceived the message from the Fed as hawkish. But really it wasn't. If you listen to the press conference and actually read the statement, I look at it as dovish. Because what they're saying is that, look, to battle inflation, back in the 1980s, we had inflation that ran about 15% on the CPI. Right now, if we calculate the CPI the same way they calculated it back then, we're about 11%. So we're not far away from that type of inflation. And the Federal Reserve Chairman, at the time, Paul Volcker, raised interest rates to 18%. And here we are, in the same inflation or at least close to it, or on our way to that. And the Federal Reserve says 2.5 years from now, we may raise interest rates 2 times, 0.25% to 0.5%. That's like using a little garden hose to try to take out a fire that's like a major forest fire. It's not going to work. So inflation is going to stay with us. And that's the thing. They don't care, the Fed. They're going to allow 2.5 years of inflation to get out of control. And I just thought that was incredibly dovish. Another thing, too, is the Federal Reserve is going to continue to monetize all of the U.S. government debt, which means printing money and buying it. That's part of the $120 billion a month that the Fed has been creating and buying bonds with. And I explained to you last week, $120 billion is a lot of money. And I always go through this exercise with you because we hear these numbers all the time, billions, trillions, 100. It don't mean anything after a while. You glaze right over your head. Nobody could really envision even $1 billion. $1 billion, 1,000 million. That would be nice to be a billionaire, wouldn't it? I think I can get by on 1,000 million. But $1 billion in the big picture of world economics and monetary policy is a dime, a penny. But when they say they're going to buy $120 billion worth of bonds a month, again, what's $120 billion? It's 120,000 million. 120,000 million a month. And they don't buy these bonds with money they have in the bank. They buy these bonds with created money. And that's quantitative easing. That stimulates the economy, it inflates markets, it inflates prices of consumer goods, commodities. There's no stopping the train, and they're not going to be able to. They're not going to be able to raise interest rates enough to battle inflation because the whole economy would go into the crapper. That's how sensitive this economy is. This is how sensitive certain markets are. That just the discussion of potentially raising rates 2.5 years from now, 0.5 point, is enough to unstable markets. Enough to make mortgage rates go up, which they did last week in response to the news. They have too much power. That's the problem with the central bank. They have so much power over your life. They have more power than the Congress does, the president does. And I've railed about the Federal Reserve, its creation, it's unconstitutional, and its powers over us, and we wouldn't be a debtor nation without them. And like I said, in the weeks to come, I'm going to do another primer on the Federal Reserve. What it is, what it isn't, who owns it, how it was created, why it's so evil. So the second day after that was the initial knee-jerk reaction on Wednesday. Markets went down and everything else. And the day after the Fed meeting was an extraordinary day by any measure if you look at it. We saw the biggest dollar rally since last March during the global pandemic when it started. We saw a big drop in long-term interest rates in the U.S. bond market. Now you would say, well, why would interest rates go down if the Fed's going to raise rates? Because people are selling off the short-term debt and buying the long-term debt. It is a complicated transaction there, but so it brought yields down. And initially, yields on the 10-year Treasury went up, but the next day, yields went down. And actually, for the week, the 10-year Treasury dropped significantly and is now yielding 1.43. I think we were up at 1.8 not too long ago. On Friday, the Dow dropped over 500 points, 533 points. NASDAQ down over 100. But it doesn't really matter because all these indexers are still very, very close to their all-time highs. And we'll see if these are not overreactions, because it really is. You know, it's crazy to say what might happen 2.5 years from now. You know, in your economic lifetime, 2.5 years is forever. So many things change. They may have to raise rates later this year if inflation doesn't calm down a little bit. And for markets to make a judgment on something that may not happen until then, maybe at least 2.5 years out, is pretty stupid. Maybe I'm stupid. Maybe I'm the one who doesn't get it. Gold and silver were clubbed. Gold was down $100 plus for the week, closing at $17.68. Silver was down on Wednesday $1 plus per ounce. This is when you can't get silver. I mean, you try to buy it at dealers. Many dealers don't have any supply whatsoever. The premiums over the spot price are ridiculous. But meanwhile, silver is down 5%. Now think about it. If the Fed's going to print, let's just say they continue to do their quantitative easing for 2 more years. Let's say 18 months. To the end of 2022. Let's just say they go that far. We have 18 months times 120 billion. That's $2.2 trillion. Printed and out in the system again. Highly inflationary. That's why it blew my mind to see commodities go down when they're not stopping inflation. As a matter of fact, they're continuing to create it. And where's that 2.2 trillion going to go? Stocks, housing, and commodities, like it has been all this time. So I think what the Fed has done, or what the markets have done in response to the Fed, is to create a great long-term buying opportunity in certain commodities, including gold and silver. Now, there's another problem out there. Is that the Fed has been doing what's called reverse repos. What is a reverse repo? A reverse repo is when the Fed takes money out of the banking system. There's too much money out there that are doing nothing. Banks have trillions of dollars that are sitting there doing nothing, and if they don't do anything, they have to go someplace for a little bit of return and safety. And there's a risk, without getting too complicated, that when there's too much money floating around in the banking system, that rates get negative. By bidding up money market instruments to the point of where they go negative. And you want to see the financial system quake. Let money market accounts become negative return and break a buck. So the Fed doesn't want that to happen. So what the Fed is doing is they're sucking that money out of the system. And they do it through a complicated thing called reverse repos. So what they did is they were offering 0% interest on money that was kept at the Fed. And these banks can keep money in reserve at the Fed. Here, hold this money for us until we need it. So the Fed moved it from 0% to 0.05%. 0.05%. And the rate on excess reserves went from 0.10 to 0.15, 15th 100th of the percent. But that's still higher than short-term treasury bills. So what these banks have done in response to that, in one day, moved $756 billion, $750 billion out of their banks into reserve at the Fed, taking that money out and preventing that negative interest rate scenario. It's complicated stuff, but it's crazy. Nobody's ever seen anything like it before. The day before, it was $521 billion. And it's likely they're going to continue to do that. Stunning stuff in the markets this week. And the problem is, there's just too much liquidity out there. The world is now awash in excess money because of all the central bank printing. And the greatest inflationist, monetary inflationist, is the Fed and the Bank of England. And again, threatening money market rates. So that's what happened this week in the Federal Reserve. It is incredibly important what's happening in markets right now. Now, again, markets are still, the stock market still close to record highs, although it looks like it's breaking right now. I will tell you this, if I was a stock market investor right now, I'd be extremely nervous because we're starting to see volatility. We're starting to see markets react to the potential of tighter money down the line. And the worst thing for the markets would be the Fed coming out in their next meeting and say they're going to gradually taper their quantitative easing. That's like withdrawing heroin from a heroin addict. It doesn't end good. So fascinating. We're going to be monitoring the markets for you here. Gold and silver investors were sending me emails freaking out because gold and silver. It's ridiculous. It's ridiculous. This is the paper market. They can do anything they want with it. And there's something else coming up at the end of the month called Basel III that limits the valuation on your balance sheet for futures contract for gold and silver. You have to have the actual physical to have 100% credit for it. Again, complicated accounting stuff, but big stuff anyway. So, if you were short, metals, and you see that coming down the pike, and that's the big banks, they knew this was coming. And probably with the Fed's blessing and the Fed's money, they bombed gold and silver. Just when it was breaking out. I mean, it happens all the time. You want to talk about a manipulated market, that's it. You see, the metals market showed you that the Fed is serious about raising rates. Yeah, maybe 2.5 years out. Somebody had a good analogy here. I got to find it about what this means. Like, I forgot what it was, but he said, 2.5 years from now, if I said this, would you react to it? And people said no. Why are financial markets doing that? Also, Bitcoin and other of the cryptocurrencies are getting hammered again. Bitcoin topped out at 64,000 a couple of months ago. It's now 34,000. And that's the danger of cryptocurrencies. They're so volatile that you can get your head handed to you. And there's stories of suicides of people who put all their money in Bitcoin at the wrong price and now lost half of it. And if we break 29,000 on Bitcoin, it's probably over for Bitcoin for a long time. Very, very dangerous to cryptocurrencies because they don't represent anything. I still get questions from people, what is Bitcoin? And I say, I don't know. I don't know what it is. Well, what is Dogecoin? I don't know. What is Ethereum? I don't know. There's 400 of these made up digital whatever, digital tokens, digital baseball cards, whatever you want to call it. But since there's a finite number of them and people are all chasing after each other to bid them up, this is exactly the type of mania that ends in crashes. It's a greater fool theory. Well, it's 55,000. I better buy some because it's going to 500,000. I heard somebody say. Elon Musk said it's good. Carl Icahn's in there now. So you're the last one at the party. You pay 60,000, 64,000, 55,000. It doesn't matter. And now it's at 34,000. What do you do? Well, a lot of people, crypto investors, are having religious experience. And now determining, do I sell and save what I got? Which only exacerbates the decline in the market. Or do I ride it out and hope that it doesn't go to 20,000? Like any other asset sector, people over-allocated to it and heard their friends getting rich on it and came late to the party, put everything they had in it, and now want to kill themselves. And I don't say that jokingly. There's been a significant number around the world of people that have committed suicide because of the cryptocurrency decline. But getting back to the Fed, they are not going to stop their asset purchase. They're going to talk it up like they're going to stop it sometime. They can't. They're going to be increasing their asset purchases because the deficit is going to continue to grow. And nobody else wants the bonds, so the Federal Reserve are the ones that have to buy it. This week, the U.S. federal budget deficit grew to $2.1 trillion during the first 8 months of the current fiscal year. Federal receipts, which is taxes, jumped 29% to $2.6 trillion during the period, thanks to increased corporate and personal income tax receipts, reflecting a reviving economy and consumer spending. But federal spending for the period rose 20% to $4.7 trillion, also a record, as the government kept paying $300 weekly unemployment compensation, $1,400 stimulus, $600 stimulus before that, PPP loans, nutritional assistance, loans to small businesses, and the growing federal deficit, which is going to be a record this year. I mean, it's 2.1 now. It's going to be 3 by the end of October, which is or the end of September, the end of September when the fiscal year ends. Where does that money come from? That money's printed by the Fed. The Fed buys it through quantitative easing, and they can't stop because the deficit isn't going to stop. Now, right now, the United States spends about 9% of its budget paying interest on the debt. That's going to obviously have to come up because interest rates are going up sometime. And if we have to devote more money to debt service, which will go parabolic at some point, then there's less money for services and other programs. And one thing we know about politicians, they're very bad at cutting spending. They don't know how to do it. So very interesting times from a monetary standpoint. I think inflation is here to stay, and it's going to be the big subject for a long time. Whether or not the Fed will have to battle it and has the wherewithal to do it without cratering the world economy will be interesting to see how this thing plays out. And we'll report it to you here each and every week right here on The Financial Physician. Let's take a break. 732-505-1160 is the call number. My name's Lou Scatigna. Don't go away.